As tax professionals, we're often taught to see due diligence as just another box to check, a chore, right? But what if it's not a chore at all? What if it's your single most powerful professional shield? In this explainer, we are going to go way beyond the basics to really get into the nuts and bolts of IRS due diligence, the stuff that actually matters, the insights that separate a preparer who's protected from one who's at risk.
So let me just ask you straight up. Are you truly confident that your current process would hold up if the IRS came knocking? It's a really simple question, but man, the answer can be complicated. A lot of really great, well-meaning preparers have blind spots they don't even know are there.
Let's start with the number. I want this number to really stick in your head. $650. Now, this isn't some average fee or a client's refund. This number is the anchor for our whole conversation today because it represents a huge and frankly often misunderstood professional risk.
And here is the absolutely critical detail. That $650 penalty, it's not per return. Oh no, it's per failure. So let's say you miss diligence on the earned income tax credit, the child tax credit, and head of household status for just one client. That's 3 failures on 1 return. You do the math. That's almost $2,000 in penalties right there. The cause and effect is brutal. A tiny oversight can lead to massive, stacking penalties.
So, how do you build that shield we were talking about? Well, it's not about trying to memorize thousands of pages of regulations. It's about building a system, a defensible framework. And the good news is, the IRS has laid out a really clear one built on 4 essential pillars. If you can master this, you're not just compliant, you're confident. Let's break this system down. It all starts with the knowledge requirement. That means you have to actively ask questions. You have to probe, not just passively accept whatever the client tells you. Everything you learn then feeds directly into the worksheet requirement, making sure all your calculations are based on facts. Then, you certify all this work on Form 8867. And the whole thing is held together by the 4th pillar, the record-keeping requirement. That's your paper trail. That's what proves you did the first 3 steps right. See? It's a whole process, not just a checklist.
And this brings up a perfect example of a non-obvious mistake so many preparers make. They realize after filing that they forgot Form 8867, so they mail it in separately. But you've got to think about it from the IRS's perspective. They get hundreds of these orphan forms. They have no way to connect them to the original return you filed, which means mailing it in by itself does absolutely nothing to protect you from penalties. It has to be filed with the client's return, period.
Okay, so let's zoom in on that first and honestly most important pillar, the knowledge requirement. This is the big one. This is the critical shift from being just a data entry person to being a true diligent professional. And it all comes down to asking the right follow-up questions.
This is a huge trap a lot of us fall into. We think, oh, I know this client, I've done their taxes for a decade, nothing's changed. Well, the answer from the IRS is a loud and clear yes. You absolutely have to probe. Every single return, every single year. People's lives change. A kid moves out, a marital status shifts. Your questions and, more importantly, your notes need to reflect the facts for this tax year, not last year's. And this shows you exactly what that looks like. A client says, "My niece lived with me all year." A passive preparer just checks the box. A diligent preparer asks, "Okay, great. And just to confirm, did her parents have the legal right to claim her? And can you clarify where she lived for the other 6 months?" Or the client says, "I'm the head of household." The diligent preparer doesn't just take their word for it. They say, "Okay, let's just quickly verify who lived there and who paid the bills." It's not an interrogation, it's just a professional conversation. And this quote just perfectly sums up the standard you're held to. You are not an auditor. You don't need to ask for every last grocery receipts. But if the information a client gives you seems wrong or inconsistent or just plain incomplete based on other stuff you know, you have a professional obligation to ask more questions. Ignoring red flags is simply not an option.
Which leads us right to the pillar that is your true shield in all of this, your documentation. Because let's be honest, when the IRS sends a letter about a return you did 9 months ago, your memory of that conversation is worthless. But your notes that you took at that time, that is pure gold. That is your best defense. It proves you did your job.
So what does that defensive paper trail actually look like? Well, for 3 years, you have to keep a copy of Form 8867 and your worksheets. That's the baseline. But the most important evidence is your record of the questions you asked, what you asked, when you asked it, and what the client said back. And of course, if the client gave you any documents that you relied on, you've got to keep copies of those too. You're not just storing files, you are building evidence.
So what happens when diligence goes wrong? Well, the IRS response isn't just random. It's a very predictable, escalating system. It's designed to educate you first and then penalize you later. Understanding the sequence is so key to really getting what's at stake.
It almost always starts small, with an educational letter. Something like, hey, we noticed a pattern here. If things don't get better, it can escalate to a knock-and-talk visit from an IRS agent. Yes, an actual agent showing up at your office. From there, it moves to formal penalty assessments. We're talking real money. And for the most serious or repeated failures, it can end in a referral to the OPR, the Office of Professional Responsibility. And those are the people who can affect your variability to practice.
Now that brings up another really critical and often misunderstood part of this whole risk picture. A lot of preparers just assume that the only way they'll ever have to deal with the OPR is if an IRS audit goes south. But the reality is so much broader than that.
And this is where another one of those hidden assumptions can really get you into trouble. Sure, referrals to the OPR come from IRS employees after an audit. And yeah, they come from clients who aren't happy. But look at this. A huge number of them also come from other tax practitioners and state licensing boards. The big insight here is that your risk is not just between you and the IRS. Your entire professional community is watching.
So let's end with this. I want you to really think about this. When you look at your own client files, what story do they tell? Is your documentation a powerful, solid defense that proves you did the work, or is it so sparse that it's basically an admission of failure? The answer to that question defines your real-world risk.